David, thanks for coming. Welcome to the A Game podcast here. And it's quite funny because you and I are both, we're probably 4 or 5 miles apart or even less than that. And I believe we used to live, both of us, on the Upper West Side. And this is the first time, and you've been a client for, I don't know, 10 years or more. That's the first time we meet in person, right?
It is. Good morning. Thanks for having me.
Good morning. Yeah, of course. Pleasure meeting you. So David is, one of the leading real estate investors, and your specialty is, of course, the multifamily sector, which is one of the largest, and that's what I learned from you, one of the largest parts of the commercial real estate. So tell us a little bit about, in your words, so where, do you specialize?
So, multifamily by capitalization overtook office probably just before COVID, certainly during COVID. It is differentiated by the fact that leases are 1 year on average instead of 5, 10, or 15, as you would have in a more commercial, whether office or retail setting. And therefore, it's a better hedge against inflation. It's also a more predictable cash flow. And I believe that's why multifamily has overtaken office to be the larger, in terms of capitalization, sector of commercial real estate. What we do in multifamily predominantly is invest in value add opportunities, meaning we acquire assets that are usually between 10 and 30 years old. Mm-hmm. And we try to find opportunities, assets, where there's an opportunity to improve the physical plant of the building, improve operations, perhaps rebrand the building to change if there was any kind of negativity associated with the previous ownership and operations, really start anew and establish the project as, a better solution for housing in a particular submarket, right? So that's, in its core, that's our business. We've also invested in the ground-up development of multifamily, but the overwhelming majority of our investment cases have been acquiring a project, renovating it, focusing on the operations, and improving the quality of the service and product that we're offering to our tenancy.
Sure. So it was very interesting when I talked to you last time, because most, the information that, based on my limited knowledge of this sector, has been that this, sector is going to be challenging given the cap rates and the labor costs, the material costs, and all that. And when I talked to you, and you told me, not really, and you see a big opportunity. So talk to us about where are the areas where you see positivity in all that's going on with the new administration.
So first off, the commercial real estate business is a very cyclical business, and multifamily is no exception. The cyclicality here really is there's a period of expansion followed by a period of contraction or lack of movement in one way or another, and then another period of expansion, growth.
Right.
Where we are today is following a very prolonged cycle. Usually cycles are 7 or 8 to 10 years. This was a 12 to 15 year cycle. And this cycle was extended by really two big components. One, COVID, right? Mm-hmm. The lack of activity for 12 to 20 months as a result of COVID extended the cycle. And two, the way we were able to get out of the last cycle or start this last cycle, if you will, following the Great Recession was, in many ways, the Great Recession was caused by too much leverage.
Sure.
Across a number of asset classes, and also very complex leverage, one that intertwined financial institutions and investors from all over the world into one asset, for example,
sure,
through a variety of securitizations for the most part. And the way that we as a country got past the Great Recession was led by the Federal Reserve, led by our Treasury. We did two things. We lowered rates to zero.
Sure.
And we let our banking institutions allow most borrowers to what we called extend and pretend.
Right.
So we basically used leverage to fix a leverage problem.
Right.
It sounds silly, but those two issues, COVID and this leverage, more leverage, extended our cycle from 7 to 10 to... And so why now is because following this period of contraction that we've experienced over the last 24 months started or kicked off by the Federal Reserve's fight against inflation, we now have this situation where values are depressed, and they're depressed from two perspectives. The way we arrive at value in multifamily and commercial real estate as a whole is by taking a capitalization rate and dividing it by the net operating income, right?
Right.
So basically getting to a value. Well, if your net operating income and cash flow is depressed because for whatever reason, for the most part, it's driven by supply and demand. And so there's been a huge growth in demand, but there's also been too much supply, especially in some of the fastest growing, what we call gateway markets.
Sure.
And so the last couple of years, it's been harder to raise rents because although you would think that brand new Class A projects, which is what gets built for the most part, doesn't really compete with the 30-year-old 1980s or 1990s vintage multifamily project, there usually is 30 to 40% discrepancy between rents.
Right.
But if a new project is trying to lease up and they're desperate, they're going to give away 2-3 months of concessions.
Sure.
So a tenant living in one of these older buildings can say, wow, not for long, but for about a year, I could pay almost the same thing, not 30, 40% less or more, but 5 or 10% less or more.
Sure.
And I could live in this brand new building. So this basically forces the hand of owners like ourselves who say, well, we can't raise rents. We got to keep the thing occupied. And therefore, there is a depression at the NOI levels. NOI is not growing as it should be.
Sure.
And then there's also been a cap rate decompression. And so the overwhelming theory that if you ask most people what are cap rates driven by, they'll tell you it's the cost of borrowing, leverage.
Sure.
And it's a misnomer. If you look at the last 40 years of multifamily, cap rates and commercial real estate as a whole, cap rates are much more correlated, or basically a one-to-one correlation between the cash that's going in to a sector as opposed to just the cost of debt. Now, there's definitely some correlation with the cost of borrowing.
Sure.
But the greater correlation, almost one-to-one, as I said, is the flow of funds into a sector.
Okay.
So as the Federal Reserve said, we can't have these lower rates anymore, we have to fight inflation, they start raising short-term rates. Longer-term rates start reacting as well, but they're not direct. At that point, institutional investors, who are today probably 75%, as much as directly or indirectly 75% of our sector, said, well, if the Federal Reserve starts to higher interest rates, we should pause until they stop.
Sure.
Because we're not certain what's going to happen, but what we're sure about is there will be some impact to cap rate. Okay. And so what the impact to cap rate is actually from them stopping. Right? So we have this moment in time when you have a depression in the cash flow side and a expansion on cap rate, which is a depression in value on the denominator side.
Right.
And so from an investment perspective, you want to buy low, sell high, right?
Sure.
The basic premise, we're on Wall Street. That's, right? That's the basic premise.
Right.
And so no different in multifamily, we're in this place where we're in a historically low spot of valuation relative to what happened before. And if you could make an investment in a project and make the returns to satiate yourself and your investors in terms of the kind of returns that you need to generate, and at the same time not underwrite cap rate compression from where you buy the asset, and not underwrite too much rental expansion, then you could be in a very unique spot. Number one, you did a good deal because you've satiated all the demands of your constituency. But number two, you have created the optionality to reap much bigger rewards if, in fact, cap rates compress and rents grow higher now than you predict. And why would that happen? Well, if you look at the supply and demand, as a result of the cost of borrowing being where it is and a lack of activity, the number of new project starts have gone off the cliff.
Okay.
And we need approximately 350,000 new apartments to be created every year just to stay in balance, right?
Okay.
We're a couple of 100,000 below perfect supply and demand balance right now. Most economists project that as a result of this cessation of activity of new development, over the next 3 to 5 years, we'll have anywhere between 800,000 and 1 million multifamily units shortfall relative to balance.
Okay.
That will drive not the demand, but the demand with lack of supply will drive rents higher.
So you're saying that even though there's more development, it's still going to fall short?
Well, there is some development, but what's happening now is that there was overdevelopment in the last 24 months. In other words, the deliveries of units over the last 24 months to gateway markets was not 350,000, but between 450 and 700,000 a year.
Sure.
And that oversupply created a temporary rental problem in the sense that we have not been able to raise rents. But what happens as demand continues to grow, and demand factors predominantly are driven by new household formations, but also from the affordability of single-family homes. As we know, as rates are high, especially in the longer-term mortgage market, the 30-year bond, affordability of single-family homes is diminished. And because very little relative to the undersupply in single-family homes, which is over 2 million undersupplied homes today, is driving the price up as opposed to down.
Right.
So our greatest competition is single-family homes. And over the next 3 to 5 years, there is no reason to believe that as a option for renters is going to become a better option. And so the confluence of less new supply coming online, continued growth in demand, and absorption of the new units ending, for the most part, by the end of this year, is going to be driving higher rent growth over the next 3 to 5 years. And cap rates, and as I said earlier, have a one-to-one correlation with the flow of capital. So as institutional capital returns to the multifamily business, and we've already seen signs of it in the fourth quarter. I know we're going to talk about that a little later, but we've already seen signs as the fourth quarter of 24, for the first time in over 2 years, saw an increased activity. I think in the scale of about 25-26% compared to a year before that, in terms of the volume of transactions and the dollar amount of transactions consummated. So I think we have an opportunity because we have a depressed value based on both cash flow and cap rate, and there's good reason to believe that both cash flow and cap rate will improve in greater abundance than your underwriting. So not only are we doing a good deal today, an opportunity, but also we're preserving the optionality of hitting the ball out of the park, which is what tends to happen in the beginning of every new cycle.
Right. Very interesting. So that's very interesting. The other point you talked about last time, so we talked about, for instance, tariffs and the impact on materials, which, I would assume there's a big impact on the materials because of the tariffs, depending on where they're coming from. So a couple of things and you had mentioned where the materials come from specifically and how it's impacted, but also you had an interesting take on how this tariff thing is going to end, where I know, you're more in real estate, but I was very curious about your prediction about, so where do we end up on these tariffs? So give me a flavor for both. So how does it impact, and then where will it end?
So the greatest impact of tariffs and what happened over the last 40 to 45 days is uncertainty.
Yes.
The uncertainty has likely caused, and we don't know the numbers yet, but has likely caused, instead of a continuance in the growth of institutional investment in our sector, which, as I said, started in the fourth quarter in earnest, probably slowed down in the first quarter. That's anecdotal. I don't know the numbers yet, but my guess is we've slowed down. And that is uncertainty. Prices haven't yet been impacted. We're just about to see impact this week, next week, so to speak.
Okay.
The greatest impact, my prediction, is on the development side,
Okay.
which, by the way, punctuates my earlier point, where there's already a cessation of new starts, which are to be delivered 2+ years out. As a result, when we look out 2-3 years from now, we'll see demand continue to grow and supply be very limited, and therefore that's going to punctuate higher rent growth.
Right.
How tariffs will impact multifamily value add, for example, there's definitely going to be impact from, there are investors who have been buying from China in earnest.
Yes.
They're buying stone, they're buying flooring, they're buying carpeting, they're buying appliances. And that's going to be a question mark, whether continuing to buy from China is going to be warranted, if it's going to make sense. As you know, over the last 25 years, the made in China model has deteriorated because it started with, we can do this for 1/50th the price.
Right.
And most economists have said that once it gets to 1/5 to 1/10 the price, because of the more complex logistics, the higher preponderance of lower quality products, and less sort of quality control, you're going to get to parity. If you layer in tariffs, I think that accelerates parity.
Sure.
Now, do I think that we're going to go back to making appliances in the United States?
But from your perspective, is that a good thing, though, or?
Well, first of all, I think of tariffs as just a tax. And I believe almost any tax is generally bad.
Right.
Right. So it's disincentivizing in all the wrong reasons.
Right.
For entrepreneurial business.
Sure.
Do I think that so the notion that the theory that the president and his team have said that tariffs are a wonderful thing, they're going to help our economy, I don't agree, and I don't believe that economic history has shown us that's the case.
Right.
I think it's the opposite. I think tariffs are critical when trying to balance trade issues, when there's imbalance. So pointed tariffs are essential. Blanket, sweeping general tariffs are just a tax. And by the way, they're not a progressive tax. So if you think about our federal tax system, it's a progressive tax. You know, that the top 2% of taxpayers pay 50% of all taxes, or 70% of all taxes. It's something staggering. So to make the case that taxes unfairly borne by the middle class or the lower middle class or the poor of our country is just stating a falsity. It's just not true. So I generally believe that blanket tariffs are bad for our economy. However, if the president and his team are successful in changing the slate of our deals across a multitude of counterparties, if they're successful in reducing the costs that our products that are exported bear, and we're able to then negotiate better trade, as free trade as possible, then it does have the potential to be what could be the best policy ever enacted by a presidential administration in the history of this country.
Yes.
So there is this potential. There's also the potential for an unbelievable amount of risk. The risk is that we lose dominance. For example, dollar leadership and dominance in trade. We lose our ability to trade and provide security for some of our cornerstone global partners. And we lose, who do we lose to? We lose to our greatest competitor. Our greatest competitor is China. So China is running around trying to say, look at America, they can't be trusted, we're here for you.
Right.
Now, ultimately, I believe that cooler minds will prevail, and they will not fall prey to bullyism. They will make the right decision, negotiate in earnest, come to agreement, and ultimately make it a more fair and even playing field. So I believe in that. Do I think we should be risking so much? No. So yeah, I disagree with the approach. I disagree with the general theory that tariffs are good as a blanket statement, but there is a potential great windfall for us as a country if the administration is successful, especially in delivering on the first, call it 12 to 17 deals, right? If we'll see that in the next couple of weeks.
Yes, no, absolutely. I mean, it's a big unknown, and as you said, next couple of weeks we're going to know. It's a risky strategy. But you mentioned a point about product exports, and I was in India 3 weeks ago, and one of the things I realized was that everybody that I saw, they are so much into American products, and whatever they see, even if it's a soap dish, it's an American-made soap dish, they're very fascinated by it. And they cannot buy it over there because of high tariffs. So I always wonder that if this opens up the Indian market to the products here in America, because there is a high demand, right? People are willing to pay for it, but they cannot find it. So very interesting. What about you also mentioned something about the labor costs, right? So because is that tied to the immigration policy right now in any way?
So I'm an immigrant.
Where
I was born in Moscow, which was at the time the USSR.
Okay.
So we were refugees. My family and I.
Who was the president or the USSR back then?
So that's a good question. There was a period of time after Brezhnev. I think we left under Brezhnev, but then there was a series of a couple of very short-term.
Yes, before Gorbachev came in.
Yeah. So there was Andropov, and then there was Chernenko. I'm not quite sure. I think we left under Brezhnev, and by the time Reagan came in, I suspect one of the Brezhnev had died, and there was already this succession that was going on, short-term guys. Right. But ultimately, Gorbachev, the sweeping changes that he had enacted, Glasnost and Perestroika, which just means to reconstruction, unwound this USSR. To me, the USSR was truly an evil empire because, communism and socialism are great in theory.
Sure.
But in practice, we're all human. And when you don't have a true democracy, and the Soviet Union was never a true democracy, you fall prey to the problem of you need a democracy not to choose the best leader, but to make sure that the worst leader leaves in time. Right. And so
very true.
I learned that in the White House, actually, between the two Obama years, from Dennis McDonough at the time, the chief of staff. As he said that, I said, Dennis, I'm going to remember that. I love that.
Yeah, no, very, very interesting. No, I understand, because I remember that time Gorbachev came in. I was a kid growing up in India, so in India, they were very aligned with the USSR, so the propaganda that we used to hear was very different, in favor of Russia mostly. Yeah. But But coming back to the labor costs, so is that tied to the immigration policy, or is it more or less independent?
So the reason I started telling you about my immigrant background is I'm a firm believer in the United States needing positive immigration at all levels of society, education, strata,
Sure.
age. We need people
That's
to.
what brought you and I here. Right?
Correct. We need people to help us develop the next new thing, technologically speaking. We need people to help clean bathrooms and conference rooms.
Sure.
And hotel rooms and apartments. We need laborers who are going to put nails in sheetrock.
Sure.
And I think that while I'm completely against illegal immigration, I am very much for legal immigration.
Sure, sure.
And I believe that if
Isn't
we do
that
not,
their policy, though? The Trump administration
I'm not sure
aligned
what
with
their
that, or
policy
we
is.
don't know?
We don't know because they have said that they are for legal immigration. But for legal immigration to occur in any kind of meaningful way to supplant the amount of illegal immigrants we've been receiving over the last 20 years, the only one way to do that is to make sweeping immigration changes with Congress.
Of course.
Have they done that? No. Do they plan on doing that? Is that a priority in their legislative agenda? I don't know. I wish it would be because, again, without positive net immigration,
Yes.
we are very much in danger of suffocating and stifling our economy and creating great inflation, to your point,
Sure.
on labor. What is labor at every level? If we have to pay labor more because labor doesn't want to do the job, right, at a lower price, or they
Right.
can't afford to work at that lower price,
Right.
then ultimately everything is going to go up in price.
Right. Now, actually, talking about Congress making any changes, I remember when I came to the U.S. 35 years ago, that's what they were talking about. Congress wanted to pass some immigration law. We're still waiting 35 years. So
Because, you know why? I think the challenge is that it's a long-winded legislative strategy, and I don't think that it bears fruit for them politically. And
Right.
unfortunately, the way our democracy has been constructed is everyone is thinking about the short term.
yes.
And that's a really risky place to be in my opinion.
Yeah, I don't know. I also tend to think, and I don't know if this is true, but I tend to think that if there is a politically polarizing issue, it's in the interest of politicians not to solve it
Correct.
and let it fester, because that's what helps them in the next election, right? If you solve it, what else do you run on?
Yeah, short-term goals, right? That's
Right,
they
right,
want to
right.
just accomplish, and no matter how idiotic their position is, by the time that the aftermath is occurring, by the time we see what's really happened, they're on to a next position, they're on to something else, and it's not their problem.
Right. Very interesting. So, by the way, we're talking about a lot about the administration and their policies, the Trump administration specifically. We're talking about in the context of real estate. Trump is a real estate developer from New York. We're sitting here in New York, and that's your playing field. Well, even though you invest all over the U.S., but you are a New York investor, and I would assume that the New York investor carries certain traits, right? Do you see Trump as being a New York investor? Do you see that as a benefit for the real estate industry in New York, or it doesn't really matter?
I think the jury's still out. I think what we've seen so far is that, yes, it would be nice. It's always nice that the person who wields power understands your perspective, right, and shares in some common goals and aspirations. For example, I know the president is very concerned about lowering interest rates on the short-term and the long-term side of things. And so obviously that's aligned with my thinking. I would like interest rates to be lower as well.
Yeah.
I also think that the Federal Reserve, for example, has been slow in many ways to react. And some of the ways that they measure inflation, for example, I think is dated and faulty, right?
Right.
I don't think the president's mentioned that, but I also have seen from the administration that the president has appointed loyalists in key positions, it would seem in greater priority for himself and his agenda over experts who
Sure.
maybe are the best at doing something, right?
Sure.
And so that is a concern. I don't know what there's aspirations to privatize, for example, Fannie Mae and Freddie Mac. I don't know if you're familiar, but
Yeah.
Fannie Mae and Freddie Mac were established at various times. Actually went public around the same time in 1969, 1970, to create liquidity in the secondary mortgage markets,
Yes.
primarily in the single-family business, and then eventually in the multifamily business. And
Yeah.
so that liquidity is absolutely pivotal when things get rough.
Right.
Right? Because they will be as little as 35% of the market, and they will be as much as 90% of the market when liquidity dries up on the mortgage market side and the secondary mortgage market side. So there's talk about privatizing them, right? If it's done right, I think it'll be great.
Right.
If it's done wrong, it's a great danger.
Of course.
So that's just one example of the policy that may be negative or positive. So I think it's a little early to tell. I'm encouraged. I like the fact that the president and some of the folks on his team share some of the experience and some of the perspectives that folks in my industry share. In terms of being in New York, I think being in New York is great. I love to live in New York, even though New York comes with lots of challenges. If there weren't challenges, I suspect it wouldn't be New York. But I also think that New York is a really, really bad place to invest in real estate.
Okay.
Primarily in multifamily. I can't speak for office. It's the biggest, most robust office market in the world. But from the perspective of multifamily, 50% of our apartments here are rent stabilized, which means that they are under some semblance of rental control.
Okay. I didn't realize it was that high.
Yeah,
50%.
it used to be higher. And so the challenge is when you have government intervention in anything, tariffs are an example. What you have is you have a faulty market. It's not a perfect market.
Right.
Because there are binary risks that come out. For example, 4 years ago, there was some talk about changing the way rules that were established in the 70s to guide affordability in apartments.
Right.
And namely, there were a couple of different ways that encouraged investors to invest in older housing stock so that units could be upgraded and major mechanical systems in a building could be upgraded. And that allowed the landlord to have a business plan, to buy a building and say, okay, well, everything needs to be upgraded. I need to spend X dollars. I can get Y rental increases as a formulaic approach.
Right.
And does it make sense for me? Is the return strong enough? Does it not make sense for me? You make that decision. What they did was they took away any way to pass down rental increases as a result of renovation, either major renovation or in-unit renovation. And as a result, it took away any incentive to maintain and improve housing stock. And because a great number of the housing stock is pre-war, or even pre-20th century.
I've lived in some of those.
Right?
Yeah.
You have unbelievably decrepit housing, which continues to be unoccupied because in some cases it's not occupiable.
Right.
And the landlord has no incentive to invest because they can't get any of that return back. So why would you invest $1?
That's right.
Right? And so that kind of thinking, political thinking for the short term, this was a progressive-minded, populist thing which totally missed the forest through the trees.
Right.
Their intent was to maintain, support, and allow for the affordability of housing. Instead, they lowered the quality of the housing, and they took away any incentive for maintenance and improvement, and without any change. Like, okay, so how about this? You take these programs away, and then you allow tax credits. So people can invest in the buildings, as a result, get tax credits, and somehow get a return. No one thought about that. No one thought
Right.
about anything. So investing in multifamily in New York City becomes a binary risk, which I don't believe I should be
Sure.
taking unless the returns are off the charts, which, because of how much capital there is here, the returns are never off the charts.
Right, right. So of course you decided to invest elsewhere, which now I understand much better. But-
Binary risk. I don't like to take binary risk.
Yeah, no, and that makes sense, right? Any investment, risk is the prime factor,
Right.
right? So, but now you're here, a New York investor. You're investing all over the U.S. Aren't you disadvantaged because there would be local investors if you go to Texas or the
Well,
West Coast? Or...
No, I think I'm advantaged because I have access. 80% of folks that I need to talk to in terms of prospective investors, prospective lenders, I can reach very easily.
Okay.
I can take them to lunch, to breakfast, to dinner, have a
But
drink
you
with
said
them,
you
have a
lived
coffee.
everywhere too, right? Did you spend time, live in other parts of the U.S. as well?
No, I
or
lived primarily in New York. I lived in
Okay.
Philadelphia for 2 years when I
Okay.
was at Penn for business school, and I lived in Binghamton for 4 years when I was at undergrad.
Okay.
Outside of that, I lived in New York.
Okay.
When I can tell you what is if I feel I'm disadvantaged, I get a letter every month now, and one of the properties we bought recently in Texas, and the city of Richardson has singled our property out to complain about every little minutia thing that they observe, and every time I get a letter, I send it back to my team, and I'm like, can't we do better here? Meaning, people want to know that who they can call if there's a problem, right?
Right.
And when they feel like that guy or that gal or that team is somewhere else, they're going to act differently. So there is a little bit of disadvantage there, but it's not insurmountable, right?
Right. No, I understand. And to your point about some of these regulations, I mean, we learn about those when we have some bad event. For instance, those wildfires in California, for
Sure.
instance, and all the regulations for rebuilding, even if somebody has their own single family home, what it takes to go and rebuild it. So very interesting. But yeah, again, talking about investment. How about being a smaller investor? There are so many bigger players in the field, and I'm sure you run into them when you're going and competing for deals.
Yep.
And so, I would have thought that, and I don't know, I would have thought that because they have more resources, broader reach, they would be able to find some of these better deals, faster, get there earlier, or, they would be prioritized when it comes to those deals. So how do you compete as a smaller investor?
Relationships.
Right.
Relationships. So you build trust by always doing what you say and saying what you do, year in, year out. You build trust by spending time with the intermediaries, the folks that matter, whose opinions matter, right, during a transactional process. We like to buy things off market to the extent possible. Sometimes things get marketed and we get a first or a last look.
Right.
Sometimes sellers want to be quiet. They don't necessarily want to blanket market. They're concerned about execution, so
Right.
they want to make sure that you can close. The larger institutional groups
Right.
come into the market like a herd of cattle,
Right.
right? They come in when everybody comes in.
Right. Right.
And it's a simple answer. From an allocation perspective, institutional investors gravitate towards not compensating their investment professionals. I'm not talking about the allocators who are funds. I'm talking about the institutional investors who are allocating to those funds.
Sure.
So they're sitting there and they're saying, okay, if I allocate to Blackstone or Goldman Sachs or BlackRock,
Right.
or Angelo Gordon, if something goes wrong, I can't really be blamed for it because I went with a big brand.
Sure, yeah.
But if I invest
Nobody
with
got
David
fired for
Valger,
hiring
but I
IBM.
invest with DV or Real Estate, David Valger, he's a small shop. Something goes wrong, I'll get blamed, I'll get fired.
Right.
Right? The problem with that construct is institutional investors should allocate towards more entrepreneurial managers and more entrepreneurial teams.
Sure.
They're hungrier. They are willing to work harder in many cases.
Mm-hmm.
And so those are the teams that get better, more unique things done. But the institutional investors compensate their professionals not to make those hard decisions. But
Sure.
they don't compensate them if they succeed. So it's a really big conundrum for an investment professional at a CalPERS or CalSTRS or New York State Commons,
Sure.
Because they'll get fired if the small manager they allocated to has a problem,
Of course.
but they won't get fired if the same problem occurs at Goldman or Blackstone.
Right.
But they won't get extra compensation if David Valger knocks the ball out of the park. So why would you invest? That's the problem, and it's a horrible construct.
So that's the larger investors.
That's the
though,
larger
right?
investors. But I will say that, from my perspective, what I find with the larger fund investors is they have to deploy $30 to $50 million per transaction.
Okay.
How many middle market $30 to $50 million opportunities are there in equity deployment? Very
Right.
little.
Right.
Very few. So they're already constrained by that.
Mm-hmm.
The fact that they're sitting in a nice office and working really hard at presenting to their investor base and presenting to other prospective partners. I'm out there stomping the pavement. My team is trying to continue building relationships with intermediaries, with owners directly, and trying to get at assets before they come to market.
Right.
So that's really the difference. So yes, there's good and bad.
But isn't that an opportunity for the smaller investors, the family offices and multifamily offices? So, okay, I'm not talking about the CalPERS of the world, but does that present a big opportunity for these investors to go and fill in the gap because they're
100%,
nimbler, right?
100%, right? It does. But, the family office type investors, high net worth, those are my that's my investor base, if you will.
Sure.
And so do they have the capacity to find, diligence, underwrite, and then asset manage a direct investment? No, that's not their job. Their job is to balance capital deployment in a variety of investments and to invest with professional and hopefully more entrepreneurial managers than the big name brands out there.
Sure, absolutely. What about when you go and compete against the larger funds, and how is the your ability to deploy capital? So when you find these properties, do you have to go and raise capital first, or how does that work?
Well, historically we've had both LP and GP co-investment capital.
Okay.
And so we had a little more flexibility. We've made a strategic decision not to raise captive discretionary LP capital.
Okay.
And so what we're doing instead is raising a little more GP co-investment capital and creating the flexibility of being able to use some of that capital to take a deal down and then bring investors in later. The risk is not more to our investors. The risk is on us that we won't get our carried interest because we don't charge in the GP business our investors a carried interest for the most part. And so if we took down an entire deal, it's no sweat off the back of our investors.
Right.
We're just not making any carried
right.
interest compensation until we are able to bring in new investors.
That's right.
So having that flexibility is critical because that allows you to execute, right? That allows you to sign a contract and go through a 30-day diligence period. Usually what happens is you sign a contract, you have a 30-day diligence period, which means your deposit is not yet hard. That 30 days is a twofold. One side is the team is doing true due diligence, physical, market, and legal due diligence on the property. The other side of the team is working their butts off trying to raise the LP capital for the deal. Right. So that happens at the same time, and then at the end of that 30 days, you as the leader of the company, you make a decision whether you want to take the risk and move forward and waive contingencies so that you could. You're now hard. Your deposit is now hard, and you have to go to a 30 to 60 day closing.
Sure.
And whether you're willing to wager that you have the capital or not. So
absolutely. So that's so we talked about a lot of topics, and some where you have more control, some where we do not have control because those things are happening at the macro level, and the known unknowns and the unknown unknowns and all that stuff. So, but if you factor all of that in and take your crystal ball for the remainder of the year, what do you see as the outlook? What's more likely? Because of course it's hard to predict, but one of the things I've learned is we still, as leaders, we still have to make some bets based on where we think things will land, right?
So let me tell you what I think will happen, and let me also say that I'm not behaving as if that's going to happen. Okay. And it's really important. So on one hand, I as I said to you, I think we're in a really extended opportunity period, and some of the policies that we saw extended that period of uncertainty, therefore extended the opportunity a little bit longer before the herd comes back into the market fully, which means we still have some buying opportunities that are discounted. I think that I will continue to try and buy in the construct that I mentioned to you earlier, which is under today's conditions. We have to be able to make the returns work without taking additional risk, without assuming cap rates will compress during our hold period, without assuming anything, frankly, will get much better during our hold period. However, I think that the following is going to happen, and this is my optimism speaking. I believe that the administration will announce in the next 2 to 4 weeks something along the lines of 10 to 15 trade deals. That's going to cover 70 to 75, maybe even 80% of all our trade.
Right.
Whether those trade deals will truly be better or marginally better or no better, it doesn't really matter. What will happen is that much of the anxiety and uncertainty will come out of the market. As a result, the Federal Reserve will be able to continue its short-term lowering. I don't think they're going to lower this time, but I'm hoping in the next meeting, by then there'll be more clarity, and they will. They're in a pickle, right? Because their job is to have perfect employment and to control inflation at a target. And the only way they can control inflation is by setting monetary policy, which controls 25% of the inflation.
But they haven't dealt with a guy named Trump before who puts a lot of pressure, right?
I think Powell is tough. I don't worry about that. I also think he's slow, and I also think he's made a mistake in the sense that most of the inflationary numbers came from the huge weighting of shelter equivalent costs. 26 to 36% of the weighting for both CPI and PCE come from that. And the way they measure it is just an abomination. I think we talked about that earlier. But so it's totally wrong. So according to that number, our shelter equivalent costs have been between 4.5% and 12.5% over the last 20 months. In reality, rents are in the last 20 months are negative 0.25 of 1%, so basically flat. So if you just take that out, our our CPI and PCE numbers are sub 1.5%, so below their 2% target rate. So they should be lowering rates. So I think that they will continue lowering rates once some of this trade uncertainty goes away, and I think that the 5 and 10 year will follow on the Treasury side. First of all, there is this notion that China and other countries are conspiring against us to use the Treasury as a trade tool. Well, the biggest buyer of our treasuries are ourselves.
Sure.
And so the expected buyers of our treasury are still ourselves. It's our pension funds, it's our 401ks, it's us, it's our institutions.
Yeah.
And so I think we'll be fine. I do think we've damaged the 30-year, perhaps beyond repair, and therefore it'll be artificially high for a long time, which is good for multifamily because that's the driver of cheap debt in the single-family mortgage business, which means if there's no cheap debt, then affordability slants towards multifamily, even in a raising rental rate environment.
Right.
So,
right.
so to come full circle with you, I think I'm optimistic we're going to get 50 to 100 basis points of Fed fund target lowering before the end of the year. It'll come mostly from June onwards. I think my personal target, and this is optimistic, is for the 10-year to be 3 and 3.5%.
Right.
And therefore the 5-year be 25 to 35 basis points inside of that.
Okay. Very interesting. By the way, very interesting conversation. And I was wondering, and I'm sure you were too, that great topics, but I'm sure you're wondering, why am I talking to a CRM vendor about all of this? And I think, I have two answers to that. Number one is...
Are you asking yourself the questions now? I love it.
Good point. Good point. And I think I have two answers that I figured out. One is obvious, that Navatar's focus is, singularly on making sure that, we solved the key problem that any company has, any of our clients has. And so I think that's our focus. Number two is, you're one of the most tech-savvy guys that I've seen. And, you embrace technology, and not everyone is that way. So when it comes to using intelligence, whether it's finding deals, investors, or so forth, AI, and all the things that you've talked about that you've been doing, you are ahead of the curve in that sense, right?
I never think of myself as being ahead of anything. And I never think of myself as being smarter than everybody in the room. I try to, I always think of myself as being the sort of average or below average in the room, and I try to work harder for it. We have not used artificial intelligence in any kind of meaningful way to find opportunities or to better, more impactfully manage our opportunities. I do think that's coming. We're testing some things out. You and I talked a little bit about it. We record, as of a year and a half ago, we started recording all our assets. We do formal asset management reporting on every asset and every fund every quarter. And, people don't like to read. You would think that simple, for me, if I could read, a quick summary on an asset, it's better for me, right? But a lot of people don't read it. And so what we've done is we've instituted a practice where we're recording on top of providing the written form. We're also just talking through it and doing a live video recording while doing that. And I think that I was toying with the idea of having AI do podcasts around it where it's, sounds like us, but it's not us, to create more efficiency. And I was about to execute this quarter, and I stopped myself and I said, now, if I'm an investor and I get this audio, which is a podcast of two people, and the voices sound like David and one of my team members, and in reality, it's AI.
Right.
Would I be happy? As an investor, I would not be comfortable. And so I put the kibosh on that. Where I do think would be interesting for AI to scour, and I'm actually contemplating how to do that right now, is to try and find assets that are in more danger, that are teeter-tottering on the abyss, where the owners have held out for a long time in hopes of a market improvement and are, have to give up, right? Because they have a refinancing deadline or a new cap acquisition looming, and they need to get things done. Right. And so I think that's where I'm going to focus my efforts from an AI perspective. I don't know how easy or complicated it is. I haven't taken those steps yet. I'm sure people have already tried this approach, but I'm hoping that instead of having to speak to, a couple of hundred folks in every market, that'll truncate my list to 20 or 15 and make my time more impactful.
Okay. Anything else, by the way, David, that we did not cover today that is relevant from your perspective, you think?
I want to hear about. I love this idea of a podcast. I want to hear about how you're going to roll out new things or new solutions from Navatar that are going to help us. Yeah,
certainly. I think that from Navatar's perspective, there is a big shift, and the shift is, it was 3 years ago when I went around and talking to a lot of our clients and competitors' clients, and I talked to CEOs and MDs, and what I realized was no matter which CRM they used, 95% of the executives never logged into the system. And I thought, okay, that's not right. So for them, technology, CRM was a reporting system. And I thought that I'm not going to be successful until someone like you logs in. Now, you are unique because you are tech savvy and you log in, but most people...
I do log in. I have a really... my head of acquisitions doesn't, and I can't wait for him to see this podcast. I'm singling him out because I want him to use it more.
Sure. But I think from our perspective, what we realized is we have to step up our game. So we have to talk to folks like you, make sure we understand what your problem is and can we solve your problem. Because until I can do that, we're going to not be able to make meaningful change. And that's my goal.
Well, I look forward to it. The future sounds bright and scary as always.
Of course. Well, thank you, David. Pleasure, meeting you face to face the first time, and I hope that we make it a regular feature.
Anytime. Thank you for your time. Pleasure to be here.
Likewise.